Now it's time to welcome our next guest, David McAlvany. He's the CEO of the McAlvany Financial Companies, including International Collectors Associates, Vaulted, McAlvany Wealth Management, and the Tactical Short. He's also the author of the book, The Intentional Legacy. David, thanks for joining us today.
Great to be with you. I'm excited about our conversation today.
Now, we talked about how alternative investments as a class mean different things to different people. And in most cases, for most investors, let's say 90%, our last guest, Heck, said 99% of investors, are for whom alternatives are really not suitable. But let's talk about that 1% for whom they are suitable. When do you see alternative investments really fitting in? For what purpose and what types in your personal experience?
Yeah, so I think the first thing to say is that diversification is key, whether or not you're in that 1% or not. And you have a wide array of choices if you do have a few more dollars to push around. So diversification is pretty critical. What you gain with some of your alternatives is the ability to move towards non-correlated assets, things that don't necessarily move right in lockstep with the stock or bond market, but may offer a positive rate of return, just geared a little bit differently.
Now, it's interesting. Our last guest made a comment that he said they're very difficult to stick with, these alternatives, when you're buying an alternative for diversification purposes like you just described. Why? Because the average investor says, well, the asset itself is going up, this alternative is going down, I want to sell it. But that is the point of diversification, isn't it? One zigs while the other zags. So what do people need to do in order to stick with that initial plan if they're using alternatives for diversification?
That's a great point, because I think one of the biggest things fighting against investor success is investor psychology. If something's working, you want to be all in on that theme. But the thing is, we don't have really a crystal ball to know what the future holds. So to be all in on one theme, really you don't know what happens next. And it can be painful, even catastrophic. So diversification is a key. We ran some numbers back in the 60s and again in the 2017, 2018, comparing growth stocks and gold, and found a good mix between the two because it does exactly what you're describing. It offsets some of the downstrokes that you can have in the equity markets. If you have a massive sell-off in equities, you may be playing the patience game to wait for things to recover. With a gold position, you typically have growth to offset the losses, and you never have any real big drawdowns as long as you have the right balance between those assets.
So in some ways then, in the spirit of sticking with the plan, the fact that a lot of alternatives are illiquid can actually work out to be a benefit, because in a way it kind of forces investors to stay with the plan, doesn't it?
It does. And I will say the numbers that we ran assumed an annual rebalance at the end of the year so that you're always using the same discipline, going back to your point of sticking with the plan. But the discipline is rebalance at the end of the year so that which is strong, part of it's being reallocated to that which is weak, and you're lowering your average cost basis. So the disciplines of an investor are really, really critical.
That's great. We need to take a commercial break. We come back. I want to talk about the tactical short. So I'll give you just a moment to think about what is it that you think people should consider shorting right now if they're going to go short. So you got a couple minutes to think about that during the break. We'll be right back, and you stay with us too. We'll be right back in a moment here on The Income Generation. I'm David Scranton. I'm here with David McAlvany, and we'll be right back. Now let's welcome back David McAlvany, CEO of the McAlvany Financial Companies and author of the book, The Intentional Legacy. So, I promised right before the commercial break, we talk about shorting based upon one of your companies. And right now, a lot of people might say, gosh, what's out there that we should be shorting? People would say, well, bond prices are high, you could short bonds, the stock market's high, some commodities are, gosh, you could short just about anything right now. It seems like we have this huge asset bubble. Do you find that there's more shorting opportunities now than, let's say, in normal times, or is that incorrect?
The shorting opportunities are increasing, but so is the danger, because you have the possibility of major interventions, which we saw in the first quarter of this year as a classic case in point. The big names that were shorted, The most shorted index also saw the largest rallies. There was massive short covering in the first quarter of this year. So where there is great opportunity, there's also incredible risk. What we try to do with tactical short is manage that risk down below a threshold where an investor can say, look, I've got a long portfolio in equities, and I'd like to take some of that risk out without having tax consequences from selling off my stocks. I'd like to have a protective sleeve running alongside it. Now, what we've done with tactical short is moderate the short position in light of a mosaic of indicators that give us an idea of whether or not we should be 100% short or down to 50% short or not short at all. So if the market is moving against us, we're not risk indifferent. We're not going to remain short and just sort of take it like a man. It's going to be moderated, and we're going to reduce our short exposure accordingly. So it's a very intelligently managed product with Doug Noland, who's been doing this for 30 plus years, one of the bright minds, and writes for us the Credit Bubble Bulletin, and is a great way to kind of track our thinking on a routine basis if you ever want to read what we affectionately know as the CBB.
Now, in the 40 seconds or so we have left in this segment, our previous guest talked about long-short strategies, where to become a little more market neutral to protect yourself against a downturn, you're long the stronger companies in each sector and you're short the weaker companies. Is that kind of sort of what you try to do when you try to create that collar, if you will?
Yeah, so with the tactical short, we would say there's different times and different phases that you should consider as options for shorting. And there's points in the if you want to call it a breakdown within the market where you just don't want to go there. Individual names in the early stages of a market decline are the most dangerous. And so from a risk-adjusted reward standpoint, we're going to avoid those. Indexes in the first phase make the most sense from a risk-adjusted standpoint. And then we'll look at really liquid listed put options and even individual names as a decline gets further along.
Got it.
But after 30 years of
doing
doing
David, we
this,
need to leave it there for this segment. I'm sorry to cut you off, but you can stay with us. I want to ask you some more questions. And you stay with us too. We have to take a commercial break. We'll be right back here on The Income Generation. I'm David Scranton, and we will be right back. Welcome back to The Income Generation. I'm David Scranton, and we're here with David McAlvany, CEO of McAlvany Financial Companies. David, I could tell you're one of the truly good guys. You know why?
Tell me why.
Because half of the time, when I ask somebody to stay for another segment, but I had to cut them off the kneecaps for a commercial break, we come back to the other segment and they're not there anymore. You stuck around, and I thank you for that. But I want to ask you, I want to really boil down this one final thing. What you were saying somewhat before the break was, don't bet against the Fed. And you're right, the Fed seems to be willing to do just about anything to keep the markets elevated. So that does increase the risk of going short in pretty much anything these days, does it not?
Oh, certainly it does. And that's why looking at policy responses, you've got to be sensitive to when and to what degree they may implement something that really messes with your portfolio if you're short. So yeah, on the other hand, the Fed is not godlike in their ability to control outcomes. So
But they think they are, correct?
Oh, that's very true. They've confused PhD with GOD, and they are very confident that they can kind of maintain the sun, moon, and stars in their trajectories. So, yeah, I think that's a challenge on the short side. It's also the challenge for someone who owns gold, because there are consequences to the kinds of both fiscal and monetary policies we've been running for not just years, but decades. And so I think there is some patience involved for investors who are on those tracks, whether it's precious metals or on the short side of the market. But do be aware, we've seen plenty of shocks as we've seen things just even the last 12 months move from the periphery to the core. It's not just Argentina and Turkey, but we had two really nice little wake-up calls this last year with the VIX explosion in January of 2018, and then in the fourth quarter, again, not something that the Fed's necessarily in control of. They can try to stop the declines, and that's in fact what they've done from a policy standpoint. But the fragility is still within the financial system. The amount of leverage in the financial system is immense, and I think something to be aware.
I hope you don't mind. I'm going to borrow that PhD does not equal GOD. So 45 seconds or less. Have you been able to take advantage on the short side with what's been going on with China by looking at companies where some of their suppliers might be subject to the new tariffs? Has that been a strategy you've been able to utilize successfully at all?
Yeah, well, and this goes back to sort of staging a short position. And in this particular time slice, we're not interested in individual names. So we're very interested in indexes and moderating the risk, being short particular indexes. But it's not quite time to be short individual names. Where we will see, I think, quite a bit of action over the next year or two is as we see this conflict unfold between the U.S. and China, it's not just trade. We're talking about global hegemony, and we're talking about a challenge for who controls the global monetary system. And I think the Chinese are very aspirational, and we're in the incumbent position, but it's something that you should be hedging for. And I think hedging in gold and something like the tactical short does make sense.
If we weren't out of time, I'd love to spend another half an hour talking with you about that particular concept, but we're out of time. David McAlvany, thanks so much for being on the show.
Thank you, Mr. Scranton. Great to be with you.
And stay with us. We'll be right back here with more on the Income Generation. We'll be right back.